Now, given the nature of capital assets and all those facts above, it's the desire that banks have to create debt that leads to financial crises. And the person who put this together best is Hyman Minsky, who was affected by all the above, though not enough of the complexity theory. He's a bit late for that, I'm afraid. So Minsky's financial instability hypothesis takes an economy in historical time. I'm emphasising both those words because they're both ignored by conventional neoclassical economics. They have neither time nor history in their models. In fact, a large part of what they've done over time is abolish courses in economic history. So most students of economics have never studied economic history. It's no wonder they're learning how to repeat it. So we start in historical time. There's always been some debt-induced recession in the recent past. We start studying a few years after one of those recessions. And because there's been a crisis, both firms and banks are very conservative about the amount of debt they'll consider. And as a result, only conservative projects get funded. But because the economy's recovered, most of those projects succeed. And therefore, the response of both firms and banks is to think, oh, we were too conservative. If we'd lent more money or been more highly levered, we would have made a larger gain. And therefore, the ratio of debt to equity they'll accept starts to rise, and they start to revalue assets upwards. And in Minsky's classic phrase, stability is destabilising. Because we live in an uncertain economy, and because it's always been cyclical in the past, a period of tranquil growth leads to rising expectations. So you move away from equilibrium. Even if you got there, forces in behavioural terms would drive you away from that equilibrium. And now for a while that's got some good parts to it because there's been a decline in risk aversion, there's more investment, and that investment causes the economy to grow faster. But it also means asset prices start to rise, and therefore you can profitably speculate on asset prices. And of course, because the banks have got a willingness to supply money, and you're now demanding that money, the money supply expands. That enables riskier investments, some of which won't succeed, and therefore you have debt created without a cash flow to back it up. And asset speculation rises, and speculating on assets adds to debt levels without adding to the number of assets themselves, which is increasing the debt burden. And you start getting what Minsky called Ponzi financiers, for the obvious reason he's using Charles Ponzi as an analogy. Back 2 or 3 years ago, I had to explain who Charles Ponzi was. Does anybody here not know who Charles Ponzi is now? Good. Okay. It's one of those questions nobody dares put their hand up, but I presume that's correct? I'll explain Charles to you later. I might even take you on a tour of his house. I've got a film of it. Went there on my second last trip of the States. I must put an entry up on the blog about that. The woman who owns the house is a lovely person and took me for a guided tour. It was great. Okay, a Ponzi financier is somebody who has a cash flow that's less than the debt servicing costs. They make money by selling assets in a rising market, but fundamentally they're bankrupt all the time. It's only the rising market that keeps them looking solvent. Now, because they have a desperate need for money to turn over and maintain themselves with the appearance of solvency, they really couldn't care what rate of interest they pay for the debt they get, and they help drive up interest rates in general. And you've also got rising debt, which has been used on unproductive purposes, either failed ventures or speculation, which is inherently a failure. Interest rates rising as well, rising levels of debt. Finally, you get to the stage where some projects that were actually well estimated, conservatively, end up being risky in the current circumstances. Those firms enter the market to get their cash flows fixed up by selling into what they think is a broad market of assets, and their entry pricks the bubble because asset markets are actually quite narrow and shallow institutions. If you think about the volume of sales of cornflakes and compare that to the stock of cornflakes at any particular point of time, then the volume annual will be 20 or 40 times the stock that exists at any particular point in time. If you think of the number of houses that are sold per annum compared to the stock of houses, you'd be lucky to get past 5% most of the time. So the asset market is much shallower and narrower than we believe it to be. It's easily pricked by an increase in volume, unlike commodity markets. I mean genuine commodity markets, the stuff we buy on supermarket shelves. So the Ponzis are the first ones to go bankrupt for the simple reason they can't sell assets for a profit anymore, and they can't roll over their debts, and they've got a debt servicing burden that far exceeds the cash flows. So as soon as they can't get more debt, as soon as they can't sell the assets, they're cactus. So the rise in asset prices stops, and the endogenous expansion of the money supply goes into reverse. Both the people who are borrowing now try to pay their debts back much more rapidly, and banks aren't willing to lend anymore. So you get a sudden reversal of that expansion of the money supply, investment evaporates, the economy slows down, and you go into another debt-induced recession. In other words, you're back where you started from. So it's a model of a cycle. And it repeats itself once you reduce debt levels a bit, because again, one fundamental idea here is that you'll borrow money during a boom, and you'll then have to repay some of that money during a slump. Your cash flows will be less than you expect them to be. You won't pay the debt down by quite as much. But you'll also, because you come out of the scare part of the downturn, you'll start your new level inured to the level of debt you got into to some degree beforehand. So the cycle will begin at a high level of debt, and therefore you get a ratcheting up effect over time in the accepted level of debt that's seen as the floor. And eventually you get to the point where you take on so much debt that that overwhelms the economy, and it's good night Josephine, which is where we are now. Now I've modelled this by the models I showed you beforehand had constants for the rate of flow of money from one account to another. I'm bringing in nonlinear functions now, so I relate capitalists willing to invest to the rate of profit, the debt repayment rate to the rate of profit as well, ditto for the money relending rate, and I've got endogenous money creation inside here as well, where firms' investment is funded by an increase in deposits, which of course means a simultaneous increase in debt. So it's the same basic idea as the other model, but with production and prices in there as well. And here I've got to bring in the prices dynamics to explain the role of inflation in the system. And I've got population and labour growth and so on. Now, I'm not going to skip the math for your particular audience. I'm going to scare you a bit, but that's partly necessary to be complete here. So the table I showed you beforehand of the simplified 19th century system, this is adding a few extra elements to it. And the most important one here is I've got debt-induced investment turning up there, increasing the level of debt and simultaneously increasing the deposits. And that's like a line of credit, the way that firms used to get their increase in cash. It's like your credit cards. I'm using exponential functions to simulate the basic idea of behaviour under uncertainty, which came from Keynes, and that is that if you have an uncertain future, you will assume that the present is a much more serviceable guide to the future than, as Keynes put it beautifully, candid examination of past experience would show it to have been hitherto. So because we can't predict the future, we extrapolate current trends forward. And that's the basic way in which I'm bringing uncertainty into the model here. So I have a range of functions for wage setting where workers' wage demands relate to the level of employment, where the rate of investment depends upon the rate of profit, where loan repayment slows down as profit rates rise, where money lending speeds up as profit rates rise. Those functions are the only non-linearities I've brought into the system, and they're not there to cause the cycles to happen. The cycles happen inherently, and I'll show you that in a moment. It's to constrain the cycles to realistic levels. Now, the production side of the economy comes from the work of both Marx and Goodwin, and I'll take you through this step by step. I'm looking at the physical economy now and saying the physical level of output is related roughly to the level of physical installed capital in the economy. And the relation that economists use for this they call the accelerator. A rough ratio tends to be, for a country like America, that your physical output, however you measure it, is about equivalent to 1/3 your physical capital stock, however you measure that. So I've got K coming in, divide by 3, which is the accelerator relationship, and I get the level of output. With the level of output, given the labour productivity, I can work out how many workers I need to hire. So I then take the output, divide that by labour productivity, which I use the symbol A for, and I've got the number of workers you need to hire. Divide that by the population and you get the rate of employment. And then I feed the rate of employment into this function to work out what wage demands workers are going to have, where the level of employment determines the rate of change of wages. You then integrate that the rate of change of wages, and you get the absolute level of wages. Multiply that by the workforce, you get the total wage bill. Subtract that from profits, from output rather, and you get profits. And in the simple model, I've got all the profits being invested. That then gives you investment, which is the rate of change of the capital stock. I integrate that, and I'm back up where I started again. And Aaron, this is an example of one of those flowchart models that actually does do mathematical simulation. So you put that together, what you get is a cyclical economy. And I'll show you that. I'm hoping that's launching the program. Let's see. Is it doing it? Let's go over here. For some reason, it hasn't loaded that particular program. Oh, here we go. That's it here. Okay, so if I simulate that, I get cycles in the economy. Cycles in the wages share of output and the employment rate, which go on indefinitely. And if I graph one against the other, I get a closed loop in the two. It's like plotting sine and cosine against each other to get a circle. Okay. Now the cycles that occur there are not driven by me bringing any forcing nonlinearity on the system. They're caused by an essential nonlinearity, and that is to work out wages, the wage bill, I've got to multiply the wage rate by employment, that little block there. That's what's causing all the cycles in the system. So when I bring in behavioural nonlinearities shortly, where I take a look at the response of workers to the level of employment and saying it's a nonlinear relationship. So if employment's really high, they demand large wage rises, but if employment's really low, they don't accept large wage cuts. Just by bringing that in, I simply limit the size of the cycles to more realistic bounds. So the role of the behavioural cycles is not to force cycles on the system. It's already inherently cyclical, rather like your bodies are, but it's saying let's keep them to sensible levels in the same way your insulin output keeps your own behavioural cycles within sensible grounds. Now, part of what I use there is called a Phillips curve. And I'm getting technical here for people who haven't done economics before. It's a relationship just invented by a guy called Bill Phillips, who was an engineer who, like most engineers, was completely misunderstood by economists. But part of what he argued was that there's some relationship between the employment rate and the rate of change of wages. And he had three factors in his model. He said the level of employment will determine the rate of change of wages in a very nonlinear way, but at the same time the rate of change of unemployment will also have an impact. If unemployment's rising, workers will be more willing to accept wage cuts. And the third factor he mentioned is cost of living adjustments. So I bring all those together in my model, and most economists only consider one. So I've got a rate of change of wages depending upon the level of employment, the rate of change of employment, and the cost of living, rate of change of prices. And that equation, which I've hidden behind the boxes there, okay, is what you'll see later on in the larger model. Now that's got me wages. What about prices? Well, here I'm pulling a relationship out of saying what would apply in equilibrium. If you ever got there, what would equilibrium look like? Well, in equilibrium, you'd have a physical level of output, which is labour times labour productivity, would be equal to the physical demand for units of goods. Okay? Physical demand would equal physical supply. So let's see if we can work from those physical relations and work out what the price relationship would need to be. The amount of labour you would employ would be equal to the monetary flow for wages divided by the money wage. And the flow of wages is going to be equal to the share of the physical surplus that workers earn monetised by the financial system. And that is, as I show earlier in the model, is related to the amount of money that the firms have divided by the rate at which that turns over in the economy. So I've got an expression now for the flow of wages in a monetary sense. So the money demand is going to be equal to that annual flow of wages plus profits, and that's going to be equal to the money that exists in the firm's accounts divided by the turnover rate, which I explain in the model in a paper I'll attach as well. So physical demand is going to be equal to the money demand divided by the price level. So I'm now working down to work out what is my price relationship going to be that's going to give me that equivalence between the physical supply and physical demand. So physical supply to be equal to physical demand is actually that set of equations. And when I solve for the equilibrium price in that, I find that the equilibrium price is equal to 1 over 1 minus S times wages divided by labour productivity. S stands for the share of the surplus produced in production that goes to capitalists. Okay? So it's basically, fundamentally, it's a markup. It's simply saying that prices are a markup on the cost of the monetary cost of production. That's what that expression really says. And then, as a dynamic process, I'd argue that it would converge over time to that particular value. So my inflation equation is an equation saying there's going to be a rate of convergence over time to that equilibrium price. In that sense, I'm not being particularly different from neoclassical economists. I'm just thinking about it more sensibly in a monetary dynamic framework, which they don't do. Now, what I get as a system of equations is this. And you're going to be very happy that I'm not going to take you through that. Okay. What I'm going to take you through instead is showing the whole system in that program QED. So I've now got all those various reservoirs attached and a range of differential equations there as well to tie together population growth and so on. So I'm just going to now load that particular model. And show you how that behaves. Okay, so let's just bring the player up and bring up two sets of graphs here. I'm looking forward to screens having higher resolution still. I always have a need for more resolution than I get in the system. Okay, and we play this one away. Notice all the cycles taking place there. Now I'll just stop for a moment and show you what's actually going on from a neoclassical point of view. They focus just on this top left-hand graph, the unemployment rate and the inflation rate. Remember, they saw the great moderation coming their way. Well, if you take a look at the cycles here, they're diminishing over time. So it does appear to be stabilising in what they call the great moderation. But what's actually happening in the background that they're ignoring them completely is the blowout in the ratio of debt to GDP. And notice the cycles I'm getting there. It's ratcheting up over time. If I run the system through to its conclusion, you see a period where there's rising output, rising GDP, rising wages, but you're getting a higher and higher debt level, and that higher and higher debt level is coming back and constraining the financial capacity of the economy to keep on going. You notice the wage rate now starts to fall, you start getting falling prices, and suddenly what looked like a convergence becomes a divergence as inflation turns into deflation and unemployment starts to go through the roof. Okay? And that, I'm afraid to say, is pretty much where our economy finds itself now. So it's possible to pull all this together and put together what's been happening in our economy for the last 40 or 50 years. And the outcome is both the Great Moderation and the Great Recession. And I haven't done any work yet to calibrate this model. It takes a lot of time to build an empirical validation of a nonlinear model like that. But that's the actual data, as I showed you earlier, including both the Great Moderation and the Great Depression, or the Great Recession as Americans tend to call it. And this is my model's uncalibrated output. Now the numbers differ, but the qualitative behaviour is what I'm trying to capture, and that's what I think economists should be doing, looking for qualitative fits more so than empirically close outcomes. So I've taken you through those two graphs in QED. They're all there for future reference. So the insights out of that are that private debt causes both the boom and the bust. And another insight, which takes a bit of analysis to conclude, is that it isn't the capitalists who actually pay for the debt until the crisis actually destroys the economy. It's the workers. Income share over time, you notice the blue line is the capitalist share of income. That is relatively stable. That's cycling around, but there's an equilibrium level there, and it's cycling around the equilibrium. There's a rising share going to bankers over time until the whole thing explodes and they take over the whole system and destroy it completely. It's the workers whose share declines over time. That's actually an analytic outcome of the model. So the capitalists managed to pass the debt servicing cost onto the workers in terms of a lower wages and lower income share for the workers, which is one of the particularly good reasons to be offended by the fact that the adjustment burden is also being imposed on workers in the current climate. So the reduced volatility that the neoclassicals thought was a sign of the great moderation was actually what I called in a 1995 paper, The Calm Before the Storm, where I built a non-monetary version of the model I've just shown you. So that's our situation. How are we, let's get back to the empirical world now, how do we stand compared to the 1930s? Well, I want to take a look at that from the point of view of comparing that debt contribution to aggregate demand. And here I'm dividing by the change in debt by the sum of GDP plus the change in debt. So it's saying how much of the aggregate demand we see is caused by the debt factor alone. And the red line here is the 1920s to 1940s. The blue line is now. And what I'm taking as my starting point for both graphs is what you might call the point of peak debt. It's the point at which in both the 1920s and the 2000 period that the change in debt was adding the most it ever did to aggregate demand. So just before the Great Depression began, the increase in debt was adding about 7% to aggregate demand in America, whereas this time round, the increase in debt was adding about 23%. We started from a much bigger party than the Roaring Twenties were. Then you had the downturn, which began, I'm dating the start of the crisis in the 1930s from mid-1928. So the party was still going at that stage. Largely it's because I only have annual data to work with. But the downturn from that point of view was now is like 2.5 years in to the Great Depression. So that's the comparison. How big is the downturn 2.5 years in? Well, the answer is in the 1930s, they'd gone from increasing debt, adding about 8% to aggregate demand, to falling debt, subtracting about 18%. Now, we went further than that and started from higher up. We began from it adding 23% and got down to it taking about 22% off, and then there's been a recent turnaround, and I'll show you that in a moment. So the scale of downturn now is bigger than it was back then. Also, what's much bigger this time than last time is the scale of the government response. In the 1930s, you had this move from the bottom red curve to the top, a small move up. So the government 2.5 years in was doing spending that was boosting demand to some degree. In the 2000s, that was the scale of the response. And that's why now it doesn't feel quite as bad as the Great Depression, apart from the fact we're fudging the stats instead of relying upon decent stats like shadow stats publishers. But notice also that current turnaround. I've got to talk about that a bit as well. So, where are we going to go from here? Well, I've spoken about debt in several ways, and I want to bring them all together with a bit of an analogy. The level of debt is like the distance you have to drive in a journey. If you've got to drive from Los Angeles to Reno, you don't worry about it. If you've got to drive from Los Angeles to New York, it's a serious question. So that's what the level of debt is like. And that'll tell you how long it'll take to get there in some ways. There's the rate of change of debt. That's like how fast you're driving. And that's, of course, the factor in debt that determines aggregate demand itself. Then there's whether you're putting your foot down and accelerating because you know there's no cops around the road, or you're slamming the brakes on when you see lights in the distance. Acceleration, deceleration. When you're accelerating, that feels really good. When you're slamming the brakes on and hitting looking at the windscreen rather too intimately, it doesn't feel so crash hot. So the acceleration, deceleration effect will determine the change in aggregate demand, and that is whether you think you're feeling better or worse at the moment. The question is, how sustainable? How much can you go from decelerating to accelerating? And in other words, there are relationships between each of those three variables. Now, the two most important ones, in my opinion, really are the level of debt and the rate of change. And if I can steal the title of a song from an Australian rock band, it's a long way from the top if you've sold your soul. And America has certainly done that. Again, you've got a level of debt far greater than you've ever had before. Now, notice the turnaround occurred in middle of 2009, and that's when the National Bureau of Economic Research dates the recession ending. So far as they're concerned, it ended 1.5 years ago. News to most of you, I know. I think the reason they did not use this information in working out their turning point. But I think the other information they found was being driven by this, and because this turnaround did occur, that's why they thought the crisis was over. Now, to really get the crisis over, you've got to reduce this level of debt. And to get back to simply where you were before the Great Depression began in comparative terms, you've got to reduce your debt level by a full 100% of GDP. Now, that would still leave you with a large amount of speculative debt in your economy. If you wanted to get back to where you were in the 50s and 60s, you'd need to reduce your debt level by 200% of GDP. And that would give you only productive debt at that scale, but you'd need to go through something like a decade where aggregate demand was less than GDP to get there. So it's not going to be easy, it's not going to be painless. Now, the impact you're going through right now, as I've said, the deleveraging impact is as big as the Great Depression, but you've got that turnaround factor there. So you're reducing debt now as fast as you were during the Great Depression. If you level out that rate of change, that implies you may have an extremely long slump. Because you've slowed down the rate of deceleration, what you're doing in some ways is turning Japanese. That's the same thing the Japanese did. Rather than confronting the level of debt, shutting down the zombie banks, writing off the debt and starting the system all over again, they kept them alive. And I remember at the time Americans being so holier than thou about how they wouldn't do anything so silly and they'd never get in the problem in the first place. Yeah, right. So you're slowing down. And that's taking a look again at this relationship between the acceleration in debt and change in employment. There's that turnaround and the acceleration effect. Again, that's what I think the NBER has accidentally identified as the end of the recession. So it's less scary than falling at a faster and faster rate, but can it increase employment? Well, it still hasn't done that here. And of course, the rate of deceleration could accelerate once more. You get to change around your speeds. And this is where the three factors relate to each other, because you can only decelerate at a certain rate. You were decelerating very quickly, then you slow it down a bit so you feel like you're doing better. But to continue slowing it down, you've got to turn deceleration back into acceleration again. You've got to get to the stage where debt's going to rise once more. And I simply can't see that happening because every last sector of the American economy is fully debt saturated. You'd never have a level of debt like this before in your history. To think it can go beyond it, I think, is futile at the scale it is and how bad it's got to be. So to me, the only way out of this is to abolish large parts of the debt that should never have been issued in the first place. And to quote my good mate Michael Hudson, debts that can't be repaid won't be repaid. All you've got to work out is how you're not going to repay them. And if you not repay them slowly, you condemn yourself to a Great Depression that lasts an enormous length of time. If you abolish it and get rid of the banks that caused it in the first place, the shadow banking sector, it's a lot still painful, but some of the correct people get the pain rather than the wrong ones, and the pain hopefully is briefer. You also need to have reforms to prevent it happening again. And I don't believe monetary reform alone would do it, nor regulation, because fundamentally, if you try to change the nature of the monetary system, you're trying to change or abolish double-entry bookkeeping. And it's such an essential part of capitalism and so easy to do that I think it's going to come back in again. If you manage to find a way of stopping it, the banks would find a way of reintroducing it. So I'm a bit sceptical about changing the nature of the monetary system to get away from those temptations. I'm more concerned about controlling debt creation, not at the source, because the lenders will always want to create more debt, but at the sink where it turns up in the system, using a couple of systems engineering terms. And you have to reduce the desirability of debt to borrowers, because that's the key problem. The borrower's willingness to take on the debt is what lets the banks get away with it. So the key way they do that is by sucking us into asset price bubbles, and that gives you a positive feedback process. Rising asset prices entice new borrowers, and borrowing drives up asset prices. And it keeps on going, and then it breaks when the level of debt becomes impossible. You have a breakdown. That's been the history of capitalism. It's about time we got smart enough to amend it. So you have to redefine the assets to prevent that linkage between leverage and asset prices. And I've got two proposals, one of which I'm calling a Jubilee share system, in honour but not exact replication of the old biblical system. And another, I haven't worked out a term for this yet, I'd appreciate one, getting away of limiting leverage on property to the rental income of the property and not to the borrower. And of course combining those with debt abolition. So the idea of Jubilee shares is that, as we know at the moment, if you buy a share in a company and the company doesn't fold, then the share lasts forever. And that makes it possible to have greater full valuations where you can sell it to somebody else who's even more ridiculous than you are about how high they think the share price is going to go. And that gives you that potential for infinite share price rises, which of course gives you the possibility of infinite level of leverage, which is what's driving the share price in the first place. And you get a market where secondary shares, sales of existing shares far outweigh the sale of new shares. So I want to redefine shares so that if you buy the share from the company, then it does last forever just like a share now, as long as you hang on to it. You get dividends, voting rights, indefinitely. But as soon as you sell it, it becomes a Jubilee share, and that expires after 50 years. Now, it gives the person who buys it off you the capacity to buy and sell the share. They get dividends. Of course, the price they're going to pay for it would really reflect what they thought the dividend flow would be, because in 50 years' time, the dividends would stop. And it would also have a terminal value of 0, even though it might have a substantial value if you capitalise that expected 50 years of dividends out of it. But you're far less likely to buy that share with borrowed money. You're not likely to gamble. So hopefully it would cut back drastically on the gambling that currently dominates the secondary market in shares. With property, at the moment, loans are supposed to be based on the income of the borrower. That's nonsense. But what it does is it lets the banks play borrowers off each other, where a person who's either wealthier and therefore can get a higher loan, or riskier and gets a higher loan on the same income, will outbid those who don't do that, making us all have an interest in increasing the leverage level. And that gives you, again, positive feedback between the level of leverage and the price of property. And you get a blowout in loan to valuation ratios over time, which has a drastic impact. That's what's driving the price level. In my own country, back in the 1960s and 70s, the standard loan to valuation ratio was 70%, which meant if you went to the bank with a $30,000 deposit, you would be able to bid $100,000 to buy a property. Now you take that same amount of money to the bank and they'll give you a 97% loan to valuation ratio, and that means you get the right to bid $1 million. Well, guess why the prices have gone up? That's the real cause of the bubble. I would rather base the leverage that you can put against a property, because we have to borrow money to buy a property. The cost far exceeds the income of the average person. Base it not on the income of the borrower, but the imputed or actual rental income of the property, and set a rule so that the banks can secure no more than 10 times the annual rental of the property. And that means that you could get a higher price for a property. Somebody could spend more money to buy a property than another person could, but if they did so, they'd need to be putting in more unlevered money, more of their own cash, and therefore you'd get a negative feedback between price and leverage rather than the current positive one. And of course, couple both those reforms with debt write-off, which are essential, or we'll be back where we are now again in 70 years if we're not wiped out by peak oil and global warming. Thank you.